Hi, everyone, and welcome to Element 25's live investment summit today. We're joined today by Managing Director Justin Brown. Justin's going to first walk you through a company presentation and provide some updates on the significant milestones Element 25 is achieving in permitting, offtake, and finance. Then we're going to be opening up the floor to accept questions. As a reminder, on the right-hand side of your screen, you should see a Q&A panel where you can submit your questions anytime during the presentation. So without further ado, take it away, Justin.
Thank you, Jane. Good morning, everybody, and thanks for joining this latest update on Element 25. For those of you who are new to our story, we are building a manganese mine in Western Australia. We've got a very simple low Capex solution to get the project up and running to generate cash flows, and we've got a pretty aggressive expansion plan beyond that to grow the business, utilising a very large manganese resource in Western Australia, which is 100% owned by Element 25. So the slides I'm going to show you today will give you an introduction into the project and the company, and then a progress report on how we're going with delivering this project, which is currently scheduled for first production in Q1 2021. So if you are an investor, you're not going to have to wait too long to see tangible results from our efforts. Just a bit of a snapshot on the company. We're ASX listed under the code E25. We have just under 120 million shares on issue. Share price closing in on 60 cents with a market cap of 70 million Australian dollars. Cash and investments around 12 million. So an EV of sort of mid 50 millions. The share price chart on the right shows, I guess, some pretty strong performance over recent months, kicked off by the release of a pre-feasibility study in May, which showed some really compelling economics in terms of the plans to develop this project. Well supported by board of management with 7.5%, and we've got a pretty tight register with the top 20 holding just under 60% of the shares. So looking really good on that front. The delivery strategy for this project is one that is centered around a very experienced owners team. We have basically assembled a cast of experienced guys in manganese, marketing, mining, and project delivery, in excess of 100 years of combined experience. And then around this team, we've bolted on selected consultants to deliver outcomes in the environmental areas, the engineering, and permitting, and so forth. So going really well for us. These guys are a great team, and we're hitting our milestones as we push this project towards first production on what is by Australian standards a fairly short timeline. The project, although I guess our efforts are centered around a world-class manganese resource at Butcherbird. It's Australia's largest onshore manganese deposit. It's really simple geologically. It's massive. It's a regionally significant manganese occurrence, and it'll fuel our production plans for many decades once we get it up and running. And I guess just to give those of you a little bit of intro into manganese that aren't familiar with it, manganese is a substantially traded commodity. It's the fourth largest used metal on Earth. It's basically one that is required for steel. You can't make steel without it. So therefore, economic activity is driven by steel consumption to a great degree, and manganese goes lockstep with that. There are some boutique uses for it. It's used in lithium-ion batteries for the new EV batteries, so it's enjoying some increased demand from that segment. And there's some exotic sort of alloys that utilize it as well, but it's really its mainstay of demand comes from construction steel and flat steel that are used to build countries, and obviously China is one of the major consumers of this, but any developing country is a part of that story, including India and so forth. The Butcherbird project is located just south of the iron ore town of Newman in Western Australia. We've drilled out a huge resource of about 260 million tonnes, and we've infill drilled a portion of that, around 50 million tonnes of that, to measured and indicated categories, which is the basis for our maiden reserve that we recently published of about 50 million tonnes. So it's a massive resource. As I said, it'll go for a long time once it's up and running, and offer lots of opportunity to expand production and grow the business. We've got excellent infrastructure. We've got a bitumen road that goes straight through the project, and a gas pipeline, which will be really important for some of our growth ambitions in terms of providing cheap energy. 100% owned by us, so it's unencumbered. And obviously Western Australia is a well-recognised mining jurisdiction, and it was acknowledged as #1 in the world in the latest Fraser Institute survey. And obviously we've delivered a pre-feasibility study that shows that this thing can make a lot of money as well, which is important from an investor's point of view. The bird's eye view of the project that we intend to commence with, this is about 100 million tonnes of the global resource encapsulated in a granted mining lease, which is outlined in the red dotted line. And you can see there the Great Northern Highway, which is in the blue, goes straight through the project, as does the gas pipeline. The orange and red are the areas that we've drilled out to form the maiden reserve. That's the areas we're going to start production in. But you can also see there that there's a lot of additional inferred material that can be quite simply converted to reserve status as required. And that will be part of our growth plans. The geology, importantly, is really simple. So it's a flat-lying, sedimentary hosted manganese deposit. It's been overprinted, for those who have a geological bent, by a supergene upgrading event, which means that it's actually a 10% in-ground grade, but because of the nature of the mineralization, we can very easily separate the waste material from the manganese and generate a saleable concentrate. It's above the water table, so there's no dewatering, there's virtually no strip, and it's free dig, so there's no explosives required to mine this material, which makes it an incredibly simple, low-cost mining exercise to provide feed for the concentrate processing plant. And I guess the next point to make is the simplicity of that processing. So we just basically mine this material with a conventional digger and a couple of trucks. We screen out a bunch of the fine clay materials. Then we put it through a wet scrubbing process, which removes any remaining clays and leaves you with a bit of a mixture of red shale material and black manganese. And we use an ore sorting machine to basically remove the waste and leave the manganese concentrate behind, which is what goes up the road to port for sale. So really, really simple. All of these bits of kit are out of a catalog effectively. There's no custom build here. We're using really simple gear like crushers and log washers and ore sorters and screens. Nothing new, very low technical risk. And this produces a manganese concentrate product which has quite attractive value and use properties, with a grade of between 30 and 35% manganese, attractively low phosphorus, which is a deleterious element, attractively high silica, which is actually a credit in the production of silica manganese, which is where this material is going to go. Silica manganese is a precursor product that goes into the steel mills, and other impurities like mercury, lead, cadmium, and so forth are incredibly low, which makes it quite attractive in terms of an OH&S aspect in terms of these operating these smelters. We don't have any concerns about the salability of this product. We've had strong demand from potential offtake partners. You should expect to see updates on that in the near future, would be my expectation. And we've even had expressions of interest for volumes over and above what we're planning to produce on our initial stage of development. So really, really good demand. And if you wrap some economics around it, you get some really outstanding numbers. So we have a very modest capital hurdle of about 14.5 million, and that throws off at around about 30 million Australian in cash flow per year. So that obviously gives you astounding NPVs of around 283 million and IRRs of 223%, which are sort of second to none. It's very rare to see a project with those kind of numbers. And we believe that our assumptions that go into that are relatively conservative. And we're not, and we just, obviously it's a no-brainer. We have to take this project into development as quickly as we can, and that's what we're doing now. Simple payback of financing of about 6 months. And importantly, just touching on the growth again, this stage 1 development only utilizes about 20% of the total resource. So that, as you can imagine, there's huge potential to expand as well. OPEX wise, very competitive. We see ourselves sitting around the 30th percentile, and the logistics obviously being the main input, obviously followed by processing and mining. A few other bits and pieces take us to $2.80 per DMTU operating cost, which is, as I say, sort of easily in the lower half of the global production cost profile, and approaching the lowest quartile, which is obviously where you want to aim for in the long term, because they're the mines that survive all aspects of the cycle. Very resilient. Only really three things to be concerned about at all, which is the grade, which we've done substantial test work to show that we can achieve that, exchange rate and manganese price, which we don't control those last two, obviously. And then beyond that, there's really nothing. It all falls away and it becomes an incredibly resilient project. And simple logistics, we put it on to quad trailer road trains, and we truck it about 550 kilometers north to Port Hedland, and the plan is for it to go out through the Utah Point facility, which is an established bulk handling facility, which has a track record in manganese shipping, and so no concerns on access to high quality port facilities to load the ships. Only about 6 to 7 trucks per day, so it's not a big impost on the highway, and no concerns from a permitting point of view on that front either. And I guess the development timeline, one of the nice things about this project is that because of the simplicity of the processing plant design and the logistics solution and so forth, we're able to bring this into production in record time. There are very few mining projects that get up this quickly. Our first production is planned for Q1 of calendar 2021, and it's basically a three-pronged, I guess, journey. One is offtake, which is going very nicely, project finance, which is advancing well, and permitting, which you would have seen an update this week last week on this week on the progress on that front, which is going nicely as well. So all major project permitting applications are in place, and just going through a statutory process to get permitting to commence production. Alongside the permitting, we've placed deposits on long lead time items. We have granted tenure, all access agreements finalised with native title parties and pastoralists. We've locked down our processing water source. We did a capital raising through Euros recently, which underpins the near-term financing requirements, and we're on track, on time and budget for project delivery on the schedule that we've just outlined. So all looking really, really good, and we'll have our first trucks heading up the road in Q1 next year, all going well. Again, I guess for those that don't know manganese well, just a couple of sort of introductory slides to give you a bit of a taste of the situation there. Demand is strong for manganese. It pretty much goes up every year. It goes up in line with steel consumption, and you'll see incremental demand increasing as the electric vehicle transition progresses, because manganese is one of the inputs into the lithium-ion batteries that these EVs need. But you can see it's a strong, consistent growth path for the demand for manganese. If I break it down a little more, you can see there's a number of different segments into which manganese goes. There's manganese metal, and then the various ferromanganese alloys, and the one that we want to focus on is the silica manganese, which is the dark blue bars that show the strongest growth out of all of the manganese segments. So that's the one that we're going to sell our product into. It's ideally suited for use in silica manganese smelters because of the chemistry of the ore, and that's where the consistent growth, the strongest growth has been and is expected to be over coming years. If you sort of look at the supply side, I guess, for a moment, in manganese, traditionally, China used to produce a lot of domestic ore and feed their smelters domestically, so imports, were modest, but that has completely changed in the last 20 years. So now China's effectively depleted their ore domestically, and they need to increasingly go to offshore sources of ore, and where they need to basically go is Africa, Brazil, and the Eastern Bloc. So they're not going to fantastic jurisdictions from a jurisdictional risk perspective. Australia used to be a strong producer of manganese ore, but if you look at the production profile here, Grid Island only has a few years of reserves left. Boodoo Creek is in wind down mode, and Woody Woody is the other producer, which is a very, very mature mine. So we believe that time is ripe for a new producer in manganese, and that's being reflected in the demand or the interest from offtake potential offtake partners who would really like to see a stable supply of high quality manganese units from a jurisdiction like Australia, which is what Butcherbird can provide for many decades, given the size of the resource. So that side of it is looking really, really good. Price wise, look, manganese can be volatile, but we think that the future looks pretty bright in the sense that the high cost producers out of South Africa and other jurisdictions need a price which is well in excess of our assumed price in the PFS, and therefore despite short-term volatility, we think that long-term trends are looking good for where we're sitting on the cost curve. If you look at various analyst groups, Macquarie and Roskill specifically, they have a pretty bullish outlook on manganese prices. Recent volatility has been driven by COVID. There was a shutdown in South Africa, which had a pretty big impact on supply. There's obviously been a bit of a tug of war between demand fluctuations with various levels of shutdown in consuming countries, but also supply shutdowns in producing countries. So that's kind of been bouncing around, but the fundamental sort of cost curve suggests that stronger for longer, as Macquarie describes it, is probably where manganese prices are going to go. And we're pretty comfortably positioned on the cost curve to ride out any short-term volatility. So the business is looking fantastic from that point of view, from where I sit. So I guess the pathway for Element 25 is a pretty traditional one. We've delivered an economic analysis which provides a compelling story in terms of, we need to get this into production. It's an opportunity that our shareholders shouldn't miss. We're doing that now. We'll have this project delivered by Q1 2021, generate strong cash flows. And then we've got a number of ways we can go beyond that. We've got expansion potential in the concentrate business, but we've also got the opportunity to do downstream processing of the manganese. We've shown very clearly in previous work that we can leach this material very, very efficiently and produce high purity products such as manganese sulfate for batteries or electrolytic manganese metal. That work is sort of slightly on hold for now because we've got all hands on deck to get this concentrate business going. But ultimately, because of the size of the resource, there's huge potential to grow the business and become a globally significant, clean, low-cost, ethical manganese producer over a very long period of time. Look, we think there's increasing investment demand for ethically produced metals in well-regulated jurisdictions like Western Australia, and we think that provides a really good opportunity for investors to see strong, sustainable returns over a long period, which hopefully is attractive to those that aren't already on board and should generate buying interest in the long term. So I guess if you want to wrap it all up, the project, in my view, has got a fantastic set of attributes. The jurisdiction is second to none. It's a really, really simple project. The technical risk is very low. We've managed to put together a very low capital hurdle to get into production, and then we've got some really interesting expansion opportunities. I think the timing, given the dynamics around the supply side for manganese, is really, really good, and provides us with a fantastic entry point into the manganese market, and then really good opportunities to expand the business pretty aggressively. I'm just going to give you a couple of photos just to give you a sense for, I'm not sure how many non-Australian investors might be in the room, but just to give you a sense of the landscape. That's a bird's eye view of the deposit. It's located remotely, but has no, the nearest town is about 130 kilometers away. You're not interfering with anyone out there. It's a really simple development proposition, flat, low-lying, straightforward. Basically, that's an ore sorter, so that's part of the kit that we're going to be using in the processing plant, and that's the final stage in the separation of the waste material from the concentrate that we're going to ship out. Just process proven, off the shelf kit. You basically ring up and order them, they stick them on a ship and ship them out to you. Really straightforward. So that's in a nutshell. Thank you very much for listening, guys. We've got some time to take questions, so I'll hand it back to Jane to manage that. But happy to take any questions you might have on anything that I've talked about or anything that I haven't talked about today.
Yeah, thank you very much for the presentation, Justin. As a reminder, everyone, you can post your questions in the Q&A panel on your right-hand side of your screen, and I'll be able to see them. Thank you. So, Justin, the first question comes from Patricia. Obviously, logistics can be a significant portion of the cost of the project. So, are you looking at ways currently to reduce that cost?
So we are. So there are some larger trucking solutions that we can explore to get permitting for, to bring the cost down further. Unfortunately, we're not going to be in a position to put rail in. The capital cost will just be too high. So it will be a trucking solution, but I guess the balancing aspect is that because the rest of our operating costs are so competitively low, we can absorb that trucking cost and still remain very, very competitive. So yes, we will look to optimize, but it will be a trucking operation for the foreseeable future.
Thank you. Here's a question about permits. Lee and Harry kind of asked similar questions. Lee's asking, how long does permitting approval process usually take? And Harry follows that up with, are all permits in place right now?
Yeah, no, fair enough. And permitting is always one of the risks, I guess, with project delivery. Ours is a really, really benign project. So all of our waste materials have no deleterious elements in them. There's nothing environmentally sensitive about what we're producing. We're not using any reagents other than water. And so it's a much simpler project compared to, say, a nickel project, which might have all sorts of heavy metals, or a gold project that uses cyanide. So we have no concerns about getting permitting, but no, they're not in place yet. It's a process we need to go through. Generally speaking, the longest lead time permits will take somewhere between 12 and 16 weeks from submission. Those have been submitted, so the clock is on with those ones, and that's in keeping with our planned development schedule.
And kind of related to the permitting question, Harry follows up with, are all native titles taken care of?
Yes, native title agreements are in place, and not an impediment for us.
That's excellent. So here's a question from Leanne. Leanne is asking, how does the Butcherbird project compare to some of the other mines, manganese mines, such as Jupiter's CP mine in South Africa?
Yeah, good question. So I guess there's a few things. I mean, we produce a product which is similar but different. Our grades are slightly lower in terms of manganese. We have the high silica. They tend to have higher calcium and magnesium, which have important applications in the smelters as well. But the silica and the low phosphorus that we have sort of counterbalance some of the properties of the Shippy ore. It's complementary. We're not basically all smelters blend, so there's no smelter that runs one stream of ore. So you probably, you could easily see a smelter that uses E25 ore as well as Shippy ore in the same furnace. That wouldn't be unusual at all. So yeah, we have our own unique set of properties, but not crazily dissimilar to a Shippy product.
So the next question is from Jack. Jack's asking whether you can provide an update on the borrowing part of the funding.
Yeah, so we did an equity raise recently through yours. As I said, we've got around about 12 million on the balance sheet at the moment. Total funding requirements, depending on working capital sort of management, was in the PFS 25 million. So we've got a shortfall of about 15. We think we can bring that down because we've got some trade arrangements in terms of the way we get paid for the product that can bring that working capital requirement down. So we think that the number is more likely to be sub 20. So there's about a $10 million shortfall there. We're talking to lenders, traditional lenders, just straight debt finance. We're talking to people that offer royalty instruments to provide funding. We're looking at offtake related finance, so that might be prepays or other mechanisms to bring that capital in, and obviously there's equity if we choose to go down that path as well. But our preference is to not dilute anymore. We've got about 180 million shares on issue, so if we can use modest gearing to bridge the remaining funding requirement, I think that's the best outcome from shareholders. You'll see updates on that. I would expect in the next month. So we're on track, but I can't give you the exact details yet.
Justin, can you talk a little bit about the grade of your resource in your project and how that impacts selling price?
Yeah, so this gets a little bit complicated because manganese is traded not just on grade. Obviously, high grade from a price point of view is better, but there's also a bunch of attributes that go into the value and use for manganese ore at a smelter. So in our case, we have a very competent ore, which is important. If there's too much sort of friability to an ore, it's harder for the smelters to use. We've got very low phosphorus. We've got high silica, which is actually a credit in making silica manganese. So yeah, we will take a price which is going to be a little bit lower than the 37% benchmark price from South Africa, but not materially lower. And so it's just a slight discount to that benchmark 37% price.
Now, Harry follows up that question with how does the grade in your project compare to the graph that you showed in the graphic? And is there a minimum threshold in the offtake?
I missed the first part of that, Jane. Could you please repeat the question?
So Harry was following up on the question about the manganese resource grade in your project and how that affects price. He wants to know whether this is addressed in the offtake arrangement and how the grade, your manganese grade currently compares to the pricing shown in the graphic in one of your slides with the bar chart.
Yeah, sure. So we, so basically, this is a beneficiation story. So we mine at a grade of about 10 to 13% in the ground. Because of the geology, we can quite easily separate the non-manganese bearing clay material from the manganese lump material, which is what ultimately is the product. So that grade gets upgraded to about 33% in the processing plant. That is a very saleable grade, so there's a lot of material moved at those grades, and we've used a pricing formula in our PFS, which is a discount relative to the 37% benchmark price. And the offtake discussions that we've been having show that our pricing assumptions are realistic, and so therefore we're not seeing any real need to change our assumptions on pricing. And as I indicated, there's a lot of other factors that go to demand for this particular product, and it's not just the manganese grade. So it's what we call a medium manganese grade product. The grades in terms of global production of manganese have been dropping, like all commodities really. It's no different with gold or any other metal. Obviously the world mines its high grade deposits first. Now our timing in terms of getting this in production puts Butcherbird firmly in the medium grade bracket, which is one of the largest volume brackets. So we compete very nicely with other products in the market.
Mm-hmm. Now, still following up about the grade of the manganese resource in your project, Francis is asking, are you testing for higher grade material right now?
Yeah, we did put an announcement out a couple of months ago on some areas where we believe we have a potential to get higher grade concentrate material. So obviously we'll look to maximize the grades as we go into production. The 33% is I guess a base case, and then where we can identify areas that provide a better outcome from a beneficiation point of view. One of the areas that we talked about in that previous release showed that we have some areas that may produce a grade as high as 39%. And obviously, if we can achieve that, it does two things. One, it provides potentially a high grade stream, which increases your revenues and increases the business case, but it also offers you opportunities to blend the ore to produce a consistent material, which is obviously also very attractive to off-takers as well, because then they don't have to fiddle too much with their smelter operations. So yes, there is potential for high grades.
Mm-hmm. Now, Terrence is asking, so what grades of manganese go to battery consumption, and then what premiums exist for them?
So the material that goes into batteries is manganese sulfate, and it has to be quite pure. So in order to produce a product that can go into batteries, you need to leach the ore. So we have a flow sheet that we've developed that allows us to very efficiently leach our manganese into a manganese sulfate solution, and then you can crystallize it out to produce a product that can go into battery cathode manufacture. It does have to be very high purity. We've achieved that in test work. This stage 1 development is a precursor to pursuing ambitions to produce battery-grade manganese sulfate. So that will come, we believe, but that's going to come as a sort of a stage 2 growth opportunity. But yeah, we can do it. We've shown that in plenty of test work that we've done prior to now.
Mm-hmm. So changing gears a little bit, Justin, I know that a new generation of investors and millennials especially care a lot about sustainability. Can you talk a little bit about your key sustainability goals and how they're being managed at your projects?
Yeah, so I talked about the downstream processing. So we believe that in Australia and other countries, for that matter, we shouldn't be just shipping bulk commodities, which obviously we're going to do as part of stage 1. We've done very extensive environmental surveys on our project. There's no major impacts. As I said before, the waste streams are all very, very benign. The ore has very, very low deleterious elements in terms of the mercuries, cadmiums, heavy metals in the world. So it's not a polluting product at all. Into the future, when we produce our high purity manganese products with our unique leach process, we've got ambitions to have very high penetration renewables powering that plant. So we've done a lot of work on wind and solar in conjunction with the gas opportunity that is presented by the gas pipeline that runs through the project. And we think, as a base case, we can potentially get 50% renewable penetration into our mine, and ultimately as high as 90%. So yeah, we're very mindful of sustainability, and we have strong ambitions in that area.
Mm-hmm. Kind of related to that vein of discussion, Harry asks, do you have a reliable water source?
We do, yeah. We've announced that recently. So we did water exploration work earlier this year. Found a suitable aquifer that produces quite clean water. For those that are technical, at about 900 to 1200 TDS, so it's quite clean. And it doesn't need any pre-processing before we can use it in our process. So yes, water is established, and we've done the aquifer modelling, and the abstraction license to get permitting to extract that water has been submitted.
Excellent. Leanne asks, this is a great project, obviously. What do you see is currently the greatest risk for your project to get into the production phase?
Yeah, look, I don't think there's any particular risks. I mean, there's obviously, I guess, COVID has the potential to impact on the timelines. I mean, we need to get some of our equipment from offshore. So some of it's coming from South Africa, some of it's coming from Northern Ireland, for example. There is potential for that to be impacted by COVID-related events going forward. I don't think that'll impact the ultimate outcome, but it certainly could impact timelines. We don't see that right now. We think we're on track, and touch wood, it stays on track. Technically, it's a very, very simple project. You would have seen the sensitivity chart that I showed that shows that the 3 risks, I guess, are us being able to replicate the test work and get the grade to where it needs to be, and the exchange rate and manganese price are the sort of the other 2 that impact. So I suppose if you wanted to paint a worst case scenario, we come into production, have teething issues, the manganese prices take a hit for whatever reason, that could put some pressure on us. But we've got good contingencies in place for all of those events, including structuring offtake arrangements to provide sort of freeboard, I guess, in case of adverse events. So I don't think there's anything, any massive risks that are looming for us right now.
That's definitely good to hear. Matt's asking, how many potential offtake partners are you currently working with?
So there's half a dozen or so in discussions with us. Some of those are names that everybody would know in terms of the big traders. We're also talking to end users to have perhaps a direct arrangement with smelter owners. But there's a lot of interest from a lot of different directions, and we're just working through the finer detail of the various proposals right now. I think you'll see some announcements on offtake coming sooner rather than later.
Great. Prashisha is asking another question. She's asking, when will you release the PFS for EMM?
Look, that's kind of on hold at the moment. We're all hands on deck to get this stage 1 development into production. The concentrate that we produce from this stage 1 is actually the same feedstock that goes into the EMM plant ultimately when we build it. So I can't give you exact certainty on that now. But that work, as soon as we've got this stage 1 up and running, and it's performing, and we're sort of at steady state, we will allocate funding to continue that work on the EMM plant. So it will come, but I can't give you an exact date just yet.
Got it. And Justin, since you're talking about, thinking about when the project is getting up and running, Harry's just asking, when the project is up and running, what do you plan to do with the cash flow?
Yeah, so I guess the first step will be to expand. We're coming into production with a fairly modest volume of concentrate, which is about 350 to 370,000 tons a year. We may do a little better than that if we can optimize the plant. But that's a deliberate step because we want to establish ourselves in the market and firm up relationships with our end users. We've already had strong expressions of interest for increased volumes, so there will be a compelling argument to redirect the cash flows into expanding quite quickly. So you're likely, I think, if I gaze into my crystal ball, to see an expansion of the operation in probably year 2. Or possibly even quicker. That'll then obviously double cash flows, and then you're in a really good position to be able to fund the larger capital costs required for the EMM plant and the manganese sulfate plant. So I think you'll see, whether there's any short-term return to shareholders via dividends remains to be seen. But I think you'll see that there's actually really good arguments to keep that money in the business and expand aggressively. Because don't forget, we've got a base case here that only utilizes 20% of the resource. So there's a lot of potential to grow this business and really make it a globally significant part of the manganese industry.
Speaking of cash flows, of course, we have to talk about costs. So David's asking, on the cost curve side, can you expand on Element 25's base costs? So the all-in sustaining costs between euros 1 to 5?
Yeah, so it's you would have seen from that chart that I showed, it sits at about $2.80 US per DMTU. For those that are unfamiliar with pricing in manganese, a DMTU is each percent content of manganese is how that pricing is done. So $2.80 per DMTU, it's $2.80 US per percent content of manganese. So if you times that by 33, you can get our per ton costs. That's a very competitive cost. So that sits at around about the 30th percentile, so quite competitive, and puts it in a really good position to ride out any short-term pricing volatility. As you'll see on that pricing chart that I showed, there are periodic dips in the manganese price. There's also periods where it goes up quite strongly as well, and you make a lot more money. But obviously, you need, as a business, to be able to ride out the short-term negative pricing that does occur from time to time. We're very well positioned to do that, and you can also see from that pricing chart that that environment doesn't stay around for very long, because at that price, there's a lot of other producers that can't make a margin. So they turn off production, and you very quickly see a rebound because the manganese supply and demand is off. It's quite finely balanced, and so the price on a long-term basis tracks the 90th percentile cost producers typically, and we are well below that.
So while we're on the topic of costs, Francis is asking, what's the approximate shipping cost advantage for Port Hedland versus South Africa for China delivery?
Yeah, so there's probably two aspects to that. There's one is just the sheer distance. South Africa is much further away. They have the second aspect of that is so obviously there's cost to that. It costs them more to ship their ore. And the second aspect is that because the transit time's I think it's about 30 days from South Africa, and we're looking at sort of 12 or 13 days. So from a buyer's point of view, they carry the price risk for a lot shorter period with our ore than they do for South African ore. So that's quite attractive to them because they buy it at a price when it's loaded onto the ship, and then they potentially deliver it at a price which may be different to that. So if that's a 30-day window, that's quite a long time for them to carry that price risk. So there's two factors to that shipping cost question. I hope I've answered those satisfactorily.
Yes. So the next question, I think there are two questions that are quite similar. Both Francis and Merv are asking, are there any opportunities down the track for any value-adding opportunities?
Yeah, that goes back to the downstream processing. So, I think Australia is a jurisdiction, like a lot of jurisdictions, that tends to sort of outsource the processing to places like China and other places in Southeast Asia where the smelters typically are. We see, with our unique flow sheet that we've developed with CSIRO, we see a really good opportunity for us to establish a downstream processing production plant at Butcherbird and take that manganese ore right through to a leach step to produce high purity manganese sulfate and electrolytic manganese metal for batteries and high purity steel applications. So yeah, I definitely think there's an opportunity there, and we will pursue that when the time is right.
Mm-hmm. Paul's wondering, Justin, have you ever considered a share split to increase liquidity in the stock?
It has been raised from time to time. There's no sort of serious conversation going on about it right now, but it's in the back of our minds, I guess. I can't rule it out or rule it in going forward, but yeah, it's something that we're thinking about from time to time.
I see. Okay. Going back a little bit to getting things into production, here's wondering whether you've run a pilot plant before, and then if you have, what kind of throughput were you looking at? And if you were to do something like that, would this be a bespoke process, or is this something off the shelf?
Yeah, so I'm not sure if you mean pilot plant for the concentrate or for the downstream processing, but I'll answer both. So the way we did the test work for the concentrate production was we went to site and actually mined 40 tons of material, brought that back to Perth and used that as batch test work in one ton batches to test the processing flow sheet that you're seeing for the concentrate business. And then in terms of the downstream leaching, we've done lab scale test work, again in batches, but multiple tests on that, optimization tests, etc. We have a grant from the CRCP program, which will co-fund a lab scale pilot, and that's expected to happen next year. And so that's for the MM and manganese sulfate production. So yeah, it's in the mix, but we haven't done it yet.
Mm-hmm. And speaking of production, you may have touched on this earlier already when we were talking about different grades of manganese. Terrence is wondering about the impurities that exist within the industry. Where does your manganese resource and your product stand? And what is the price difference between a product that is impure versus what is acceptable?
Yeah, so as I touched on before, there's a number of factors that go into pricing, and a lot of it's about how easy it is for the smelters to use your product. There's obviously the manganese units that they need, but there's also the deleterious elements like phosphorus, alumina, and then to a lesser extent, toxic metals like cadmium, mercury, lead, etc., which are of a concern from an environmental point of view and an OH&S point of view. So our ore is incredibly clean in terms of the heavy metals and things. There's no radionuclides to speak of. There's very low levels of mercury, cadmium, lead, and those other metals I talked about. The manganese grade is firmly in the medium grade band of the manganese industry. Has quite low phosphorus, high silica, which is a nice credit for silica manganese production. So our pricing will be based around all of those value and use propositions that I touched on. We think we'll take a slight discount to the 37% benchmark price, but not a meaningful one.
Mm-hmm. Here's another question from Terrence. He's just asking about payment terms between CIF, cost, insurance, and freight, or FOB, freight free on board. Why is the emphasis always on CIF?
Yeah, I think it's just you do have to pay a cost if you want to give that over to the consumer, and so that's counterbalanced by the fact that you've got to carry, you don't get paid necessarily as early if you go CIF. So there's a counterbalance there. I think ultimately once your balance sheet is in good shape, then CIF is the right way to go. You make the most money that way. But in the early stages of an operation, you'll probably find that producers favour FOB, and there's even sort of trade terms that you can potentially achieve where you get some of that payment up front when you mine it at site. So it's all about managing that working capital requirement. If you need to mine it, then truck it, stockpile it at port so you've got a shipload ready, then get a ship in, then load the ship, and then take trade terms on a CIF basis. You're carrying that credit a lot longer, but again, if you don't do that, then you're giving away a margin to the consumer as well. So it's a balancing act between all those factors.
Mm-hmm. Well, thank you very much for all of your answers, Justin. I think that covers all the questions that we have from the audience today, and we're almost at time as well. I want to first of all thank everyone that submitted the questions and participated and was a part of this investment summit. And if you didn't get a chance to get your questions answered, if it was missed, or if you just think of a different question after the summit, please feel free to reach out to Element 25. You can reach out to them at the contact information on the screen right there at min@e25.com.au, and they'll be happy to answer you. There's also going to be an opportunity to leave your details with the management team so that they can reach out to you. You'll be redirected to a survey after the webinar is closed, and you can leave your information there. So finally, I'd like to hand it over to Justin for the final word.
Thank you, Jane, and just want to say thank you to everyone who attended today, and I hope you found it interesting and informative, and I hope you take a closer look at E25 as an investment proposition. We think it's a really exciting journey, and we'd love to have you on board.
All right, thank you, everyone. Take care.
Thanks. Bye for now.